Back on the show, and it's time for Ask Annex. As always, got a question for us. Head to the website, annexwealth.com. In the studio, Matt Morzy, Investment Team Manager, CFP at Annex. Hey.
Hey, Danny.
And we got Fred Coleman, CFP and a Wealth Manager. Hello, Fred.
Hey, Danny.
Question number one on Ask Annex today, tax prep time. How long do I hold on to previous year's paperwork? I've got 10 years worth.
Wow, that's a long time. And I actually went to the IRS website to figure this out, and they have a long list of time frames and different what-if scenarios. But they say anywhere between 3 and 7 years, depending on your situation. So 10 years, you're well over that. In my opinion, you should just keep them indefinitely. You never know what's going to happen, whether that's just keeping a record at home, in a safe spot with all your records, or nowadays you can keep them safely stored electronically. So better safe than sorry. I think the 10 years is a good time frame. But myself personally, I keep mine indefinitely.
Indefinitely?
Indefinitely.
Do you have like 10 cats too?
No. Do I look like a cat guy?
Matt, how long do you have?
I think we got about 5 years right now.
All right.
2 cats. 5 years in taxes.
Next up on Ask Annex, my HSA is invested 4 different ways, 2 individual stocks, 2 ETFs. In order to use those funds for bills, I need to sell them within the HSA. Is there a best way to pick what to sell?
Yeah, I think it's a good question, and how I would look at it is starting with the end in mind. So you need to take a distribution out, figure out how much that is, what are you going to have left over at that point afterwards, and how would you want to be allocated at that point? Do you still want the single stocks? Do you want the ETFs, a mix of them? But that's how I would do it. You can certainly easily sell part of all of it if you like the allocation that you had today. Personally, I'm not a huge fan of using individual stocks within an HSA. For me, there's a specific goal to that money, and I want to maximize my chance of getting to that goal with the least amount of risk possible. So I'm going to try to take some of that risk out of it by trying to pick individual stocks in that method. Now, to me, that's more of like a play account type of thing, or if you've got someone who's professionally managing those individual equities, that's one thing. But within an HSA, when I'm thinking from a time horizon standpoint, having a well-diversified portfolio is how I would go. But if you want to keep the individual stocks, that's certainly up to you. But keep the end in mind of how you'd want that portfolio at the end of the day once you take that distribution out.
Yeah, and one thing to also keep in mind is just that receipt method. Maybe now's not the right time that you want to sell. You can't think of the perfect stock to sell in this situation. Well, you don't necessarily have to. You can always pay out of pocket and reimburse at a different time. So if there's a better time to sell in the future, you can sell it then and then reimburse yourself with the cash.
And you could put the receipts next to all your tax returns.
Absolutely. If that's where you want them.
In that big garage full of stuff. All right. Next up on Ask Annex, I've been waiting for this one. My know-it-all uncle said, my husband and I are house rich but cash poor. We're contributing to our retirement plans, but we do have a large home with a decent-sized mortgage. My husband is 40. I'm 38. Are we atypical?
Yeah, the first thing I thought of, Danny, was you. I thought of you and at a barbecue, talking to some of your younger nieces and nephews, telling them this. But yeah, this is pretty typical. But also around this age is when we start to see things change. Usually between that 35 to 45 range is when people turn that corner when it comes to wealth building. And I think it's because of a lot of factors. Your kids are starting to get older. You've kind of established a lifestyle. You're in your career. You're starting to get promotions. And now you're starting to see that saving and investing that you've been doing since you started your career. You're starting to see those account values pass up the value of your home. Again, this also assumes that you're not going to purchase a bigger home. Because if you continue to do that, that does slow down the wealth building process. And in that case, likely your home will always be your largest asset. One thing you can't do is out-invest a lifestyle.
Yeah, I think one thing to look at, and hopefully that you were able to refinance or you bought when interest rates are really low from a home perspective and you have those rates locked in. Because as you get older, you start to get to a spot here too where your monthly payment is largely staying the same, other than maybe insurance changes over time, property tax changes. But the part that's actually going towards your house itself is level if you have a fixed rate mortgage. So as you do that, like you said, you have an income increases over the course of time. Your house is becoming a smaller portion of what your monthly spending is, and becomes a lot easier to not be house rich, cash poor, because you are able to build up all those other things because less and less of your money is going towards that house. But it is extremely common, especially as you're younger, where your house is the largest part of what you have. It's the largest expense that you have every single month, that it really dominates what you do. But yeah, over the course of time, you're able to work out of that if you don't, continually upsize as you go.
Can we sneak one more in?
Sure.
Okay, here we go. I like this. Single stock ETF. Why?
Yeah, that one made me laugh. There's no shortage of new and unique ways to invest, or, more likely I would say speculate. Single stock ETF is really an ETF that's just tracking a single stock by itself. Now, you probably wonder, why would you have an ETF that tracks a single stock? You could just buy the single stock. Well, the idea is that a lot of these have leverage built into them. So instead of getting pick a company and whatever that return is going to be, maybe it's 1.5 times or 2 times that performance, both on the up and the down. So you're getting leverage on it without having to open up a margin account. The other reason for it is that you could short stock that way much more easily. So shorting stock is selling stock that you don't own, hoping that the price goes lower and you're going to be able to buy it back later. Again, in order to do that, you need margin. So you need a brokerage account to do that, and they need to approve you to be able to do those types of trades. And they are very risky. One of the issues with margin is that you potentially could lose more money than what you invested into it, because if it moves in the opposite direction, you get to a spot where the loan you took out onto it and the change of the price gets you into a spot where you're underwater. By having a single stock ETF, you can both have either the leverage on the way up or the way down, but shorting stock without being able to lose as much or more than you put in, because if the price goes down, it just goes down. You could sell out of it at that point in time. So there are some benefits to it from a risk management standpoint, but ultimately it's more speculation than it is investing in either situation.
Matt Morzy, investment team manager. Thanks.
Thank you.
Fred Coleman, wealth manager at Annex Wealth Management. Thank you.
Thanks, Danny.